A few months ago, I told my story of how I chose to be a fee-only financial advisor. Today is time for Trishul's origin story. And now, on to our conversation.
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks everybody for listening and watching.
Great to be here as well. So a few months ago, I told a story of going to non-traded REIT due diligence conferences and staying at some really nice hotels where the investment company was paying for me to stay at these nice hotels. And being I was in my 20s and still young and impressionable, and it was really nice to be wined and dined. Not gonna lie. But eventually I kind of realized, oh, this is why the internal fees on these investments are so high. Like the money's coming out of the client investments. And so not quite a decade later, it's on the scale of 5, 6 years later when I started my firm, like I knew I wanted to be a fee-only advisor. So that's a really good story. I tell a longer version, but I encourage you to go listen or watch that story. But today is Trishul's turn. So I'm going to let Trishul have kind of free reign, kind of how he got into being a financial advisor, kind of what his background is, and why he made some of the intentional decisions as a business that he did, that we've talked about in the past. Because I think that intentional decision ideas comes up a lot with a lot of our life planning and financial planning ideas. So we want to use today's conversation as a specific example of some of the intentional decisions Trishul has made in the past and how he got to where he is today. So Trishul, what is your origin story?
Right. I was wondering how far back should I go? And then it also occurred to me, like, did I ever think I would end up doing financial planning?
And that's kind of what I want to get to. So maybe you do have to go back kind of far.
Yeah. I mean, so I grew up in New York, and I was an engineer. Like even from a young age, I was into like computers and circuits and things like that, right? So I that's the kind of mindset I brought to things. Like even in grade school, elementary school, junior high, high school, I used to tinker around with computers. This was like, starting when there were no computers and then getting the first computer without a hard drive, right? You boot up the big floppy disk and you start figuring out where the wires go because there's no resource or anything. You just got to plug and turn things on and see what happens, right?
So maybe like going from roughly like high school to college, do you have any like memories of that kind of age? Like I'm going to be an adult and like
Yeah.
I have to figure my life out kind of thing.
So like what basically happened is around high school age, or even before that, I started programming just by teaching myself. And it's one of those things where you pull up DOS, and there's something called Quick Basic. Is that familiar, Aaron, with you? Like,
No, I have not used that in
it's
my
a very
light program.
rudimentary way to program where you had like very simple commands. And I remember I didn't even know how to learn the commands. Like I just had to somehow say, okay, maybe if I do an if then, right? And things like that. And all of a sudden I learned a go-to statement where you can jump to a different part of the code and just do these various things. But then in high school, I had the opportunity to go to summer school in Cambridge at Harvard, where I took computer science for the first time. It was a college level course, and I don't think I did so well, frankly, because
Okay.
I had no idea what I was getting into. It was an actual university level course with other university students, and we learned programming. It was like 2 semesters worth, condensed over the summer. But it did give me some understanding of, hey, computers can do pretty powerful things if you know
Mhm.
what to do. And it taught me the basics of programming. And one of the very interesting concepts that I learned about was it was known as object-oriented programming. And the notion there is you create an object and you say, this is what that object can do. And then you can use it all over the place. So an
Okay.
example is you make a bicycle object, and inside the bicycle object, you put wheels and
Mhm.
you put a steering wheel. And now you can say, okay, give me 20 of these bicycle objects and scatter them around the city.
Mm.
And that way of thinking was very interesting to me because all of a sudden you can use this notion of abstraction, meaning you create these various components and then you make these building blocks and you make bigger building blocks, right? You
Mm.
make a cell and then an organ and then a human, right? Things like that. And with my engineering brain, it got me pretty excited about the possibilities of what you can do. So I went
Okay,
to,
so I've never
yeah.
heard this story. I'm actually more excited because I still have no idea how this gets back to financial planning. But okay, so
Yeah.
you're in high school. You like engineering. Did you go to college to a school of engineering? Is that what you
Right. So
studied in college?
interesting. I started as pre-med, but I
Okay.
took engineering courses initially, and then I transitioned to computer science while I was at Cornell. Um, so in the engineering program, though, that they wanted you to understand a lot of theory for some reason. So it was very
Mhm.
math based, and I wasn't too excited about it, to be honest. Like, why am I learning proofs and refutations? I want to code, right?
Mhm.
All this logic and inference and type of stuff. But there were some engineering courses that I liked. For example, all engineers, even computer science engineer, or sorry, all computer science engineers needed to take electrical engineer and things like that. And like one of the courses, we actually had to build like a simple processor, like with
Mm.
the logics and stuff. And basically, the way computer science works is you can break down all programs into just ands and ors and nots, like conditional logic,
Mhm.
right? So if you know how to make ands and or gates with transistors, you can build them up to make a processor, right? To take in instructions and spit out results. And that was like one of the key programming assignments we had one semester where they're like, okay, build a processor, simulate it, and say, take these instructions and see if you can make
Yeah.
it, do what it's supposed to do. So I really loved it. I like the engineering stuff where it was practical, where you got to put things together and learn about it, and everything was going great. Senior year started, 2020 went great, but then 2021, boom, .com crisis. So
2000 and 2001,
yeah. Well,
not
2000
2020.
part went kind of. Sorry, you're right. 2000. I'm like decades off here.
Yeah.
Definitely aging myself. Okay, so 2001, I was a senior and the dot-com crisis hit. I remember being a junior and we were seeing all these crazy offers that the students were getting.
Mhm.
Like literally they say your signing bonus is a new car, right? Like it was just silly. And we're like, wait, how'd that person get that job? He barely passed this class.
Yeah.
But it was nuts, right? It was gangbusters with the dot coms, and there was money flowing like crazy. And then all of a sudden, I start interviewing the next year because I was graduating in May 2022. Sorry, 2002.
Yeah.
And all of a sudden, the whole the whole internet thing came crashing down.
Mhm.
So here I am, a newly minted engineer in computer science, great field, but there's absolutely no jobs whatsoever. In fact, many of the students who had got jobs, they were like rescinded because these companies just went under.
Yeah.
If you recall, like if you put a .com after your name, you could raise like a few hundred million and
Yeah.
just start hiring like crazy, and that all just disappeared pretty quickly around that time. So this was like one of the early periods of my life where I'm like, oh boy, like this is a great timing. What do you do now? And what I decided to do is stick around for another year. Cornell had an engineering master's program for a year, so
Okay.
I did that. And the master's program I felt went a lot better for me because instead of being more theoretical, it was very practical,
Mm.
and you got to actually apply the knowledge that we had learned into real world situations. So I remember I had to pick 2 concentrations. The 2 I picked were project management and artificial intelligence.
Okay.
Yeah, so the very rudimentary, of course, back then. No large language models. These were like stick figures compared to today's, like rocket ships of AI. But the theory was interesting on the AI side, but what really um, got me going was the project management side,
Okay.
because at that point, I remember when I first had that lecture, the professor said something really insightful that stood out to me even to this day. He said, you know, uh, more than 50% of software projects are going to fail. And I was like,
Really?
"How yeah, like
Go on.
why? Like, what's going on here?" And he said, "In addition, almost all projects suffer from these concerns, and here are the concerns. They're likely gonna cost twice as much as you anticipate. In fact, they're probably gonna take twice as long as you think they will, in addition to costing twice as much. And on top of that, it's probably gonna require twice the amount of manpower that you think it's gonna take. So that's a factor of 8 that projects are off, and that explains a lot of failures. And it's a lot to do with the managing tasks of projects when there's, in general, but also software related, are tough to do. They're tough to estimate because in your mind, you can say, oh, yeah, computers can do anything. I just got to hook things up and then boom,
Mm,
right? But there's a whole process to think about, meaning if you miss something in the R&D phase and you don't end up catching it until it's all the way in production and a million people are using it, well, that can
mm,
spell disaster, especially if it's mission critical stuff. Like the Y2K problem, right? Things
yeah.
like that. Forget to carry the one, and your whole moon lander ends up on Mars or whatever. So project management was great because it gave me this understanding of, oh, here's how we actually think about this to get things done effectively, and here's what we can do to increase our chances of success. And I had my first job around that time in on campus. That is, I had like internships before that, where I had the ability to build software for nonprofits. This was interesting because let me think.
So
I
like
ended up on the ag school.
websites
Say that again.
or like what kind of software for nonprofits?
It was websites, yeah,
Okay,
effectively, and
okay.
these were like rudimentary. Like now, you can say, "Computer, make me a website," but before you
Yeah.
had to actually type out all the things. But it was neat because I was in the nonprofit was in the agriculture school at Cornell, and so Cornell has like 7 sub colleges:
Mhm.
engineering, arts, ag, law, etc. Right, and in the engineering college, it's basically like the dungeons at the time, right? They put us in the darkest basements, no windows. Give us like vending machines. That's our dining hall.
Yeah.
Throw down chips and flashlights in case we need them. And the ag school is like rolling fields of like manicured lawns and wide expanses, and I'm like, oh, wait, it's quite nice up here. It just got me thinking a bit laterally, so that I started bringing my laptop up there to hang out, even and just being a little more opportunistic in where I spent my time on campus. But also in the ag school, again, we started building websites for nonprofits. But it was my
Okay.
first opportunity to try out like my project management skills, right? Like,
Mhm.
so I brought in a friend or one of my classmates, right? Yeah, 2, I think, 2 or 3, and we all started to work on these types of projects. One of the first ones was building a website to rate daycares around the state of New
Okay.
York. I don't know if California has something similar. Do you have like some sort of daycare
There
rating system?
there might be it's not like an old-fashioned Yelp kind of thing.
Okay, they have stars, right?
Yeah.
and this is subsidized by the state, so they wanted to standardize the process, right? And they wanted to make it so that, okay, 4 stars means 4 stars because they met this criteria, et cetera, right? And they had ratings, and it's hard to get the full amount of stars. I can't remember if it's 4 or 5, but it was pretty neat. And I was able to push that through to completion. So I'm like, oh, okay, I do have some skills in doing some relevant
Yeah.
things. And so when I started looking for jobs towards the end of that year, I ended up at a consulting company building software for banks.
Okay.
I wanted to be on the business side because I thought I could tie in as a business consultant my software skills and lead projects and stuff like that. And what I ended up in was in the development team, the software team, because they're like, "No, you're an engineer. Like,
Is
you
this a
can't
little bit
talk to
like
clients."
you're in your early 20s and like, I'd rather go make money at a company that makes money rather than a nonprofit?
Well, no. So the nonprofit didn't really offer me a job. It was just a short-term type of
Yeah.
thing. The reason I ended up at this particular company is I had a friend who was there. He's like, "Why don't you interview?" So
Okay.
I can't really say it was too grand. But within that company, we're making software, and we have consultants that end up configuring it to banks around the country. Like Wachovia, and like, is that even a bank anymore? I hope they
I
didn't
think they were,
go under
yeah,
because
I
of
think they
what
were
we
went
did.
under slash got bought at forced bought out kind of thing.
What was it? Fleet, which is now Bank of America. A bunch of those types of banks. Like, we call
Yeah.
them tier 2 banks, not the very largest, but like the next tier down. And these banks were basically transitioning from paper-based, right, systems to paperless. This is, again, 20 years
Oh,
ago.
yeah.
So they're getting automation. So we're building these automation systems. So that's the software that we created at this financial services consulting company. Company was small, maybe 50 employees, but like 30 of them were on the business side, and maybe like six or seven were on the tech side making the software. But I had some aspirations to be on the business side because I
Okay.
thought it looks a bit more flashy, and you get to lead projects, right, to customize them
Yeah.
for clients. But they said, no, you're you have this
You
degree,
you
and
you wanna
it's
get out of the dungeon and back to the rolling
yeah,
hills
they're
of
like, oh no, go to the
finance.
cave. Right. So I ended up in the caves. It wasn't the caves, but cubicles. But
Yeah.
so what ended up happening is we had software projects which I started working on. But I remember a few weeks in, there came this consulting project where it was too small to outsource to the business people, but it was small enough so they're like, "Here, tech guys, you figure it out." And my boss gave
Yeah.
it to me. But it was a business project, which is neat. So I started looking into it, and it turned out that the project was a bit more complicated than they had anticipated. That whole off by a factor of 8 thing, right?
Mhm.
So what ended up happening is I'm working on it, and all of a sudden I'm realizing I'm a bit over my head. There's too much to do here for the deadline. But what was also happening is we had a bunch of those business consultants who were training, and they were ready to get sent out, but they didn't get assigned to a project.
Mm.
So what I ended up saying is, how about you consultants? How about you help me out on this, and I'll train you on the software side of things so that you better understand, the business and software for when you get sent out. So what that essentially meant is I started project managing, a few
Mhm.
months out of school. And, from that point on, I was basically a manager for the rest of my career for the next 15 or so years. But it gave me the opportunity to lead projects, right? Because
Mhm.
that first initial project, we were able to complete it on time. We were able to deliver it, and it was a success. And then what actually ended up happening after that is we had like a light bulb moment. I started working with the sales team to take a boiled down implementation of what I already did and use that as demos, right?
Okay.
And all of a sudden, I'm on the sales team now, showing off these demos and, getting on the plane and getting out of the dungeon, right?
Yeah.
I also realized the sales team eats a lot better when they're on the road and they stay at pretty nice places than
Yeah.
we ever had the opportunity to in the cubicle, right? The Friday pizza lunch isn't quite the same as
Yeah.
dining in a X-star restaurant, right? But yeah, so I started going on the sales team calls, and actually I started doing sales because I was able to talk to these demos that I had created.
Mhm.
And then there was one meeting where a client said, "Hey, I like that demo. Can we start with that?" And then I remember we had this meeting after. The CEO was like, "How much should we charge for this?" And I remember we just went some back and forth. He's like, "How about 250,000?" And they're like,
Okay.
"Okay, that sounds good." So what that meant is all of a sudden we had funding for a team which I headed. So
Okay.
we called it the solutions team, where we pre-made a starting kit for these projects. And what we ended up doing is, this is consulting 101, right? The way you learn what to do is you go on a few projects and you take the best of everything, right? And you
Yeah.
say, "Hey, you should do this because this is best practices,
Mhm.
etc." So yeah, so I ended up launching a new team within the company called the solutions team, where I would interface with the software team to create these high level demos that actually we call them solution packs, which were starter kits that the business team could then use to jumpstart initiatives, because it contained core things that many projects needed anyway. And it gave me project management expertise, right, in the area of leading teams, and I started growing. And what ended up happening is, if any new employee joined before they were sent out, they would just work on my team, to get up to speed on things.
Oh,
So all of
really?
a sudden, my team starts growing, to be like 4, 8, all these
Yeah.
people, and here I am, like a year or two out of school. So going quite great. But here's the shift, right? Here's the twist. Around this time, I had money for the first time, right? And I thought, okay, what do I do to put this money to work? And I remember I saw like some sort of blog or article on compounding, right, and market returns and things like that, right? And I remember I put a spreadsheet together and I said, "Here's my salary. If I can grow my salary at X and I save Y% of my salary and invest it and have that grow at Y, at what point does it turn into a good amount of money?" It was basically
Yeah.
my first pseudo financial plan, which I didn't even know was a thing.
First
But
first fire calculation.
yeah, my first fire calculation. And I quickly realized I saw that power of compounding, right? I said, "Okay,
Mm.
here's the market return. And wow, look at that. In 20 years, I can have a bazillion amount of dollars," right? And then I
I think
said, "Wait, if
there's been other phrasing I've seen, channels like in that, like, 20-year time frame, the rate of return from year 20 to 21 is greater than the amount that you can save,
mhm,
and, like, maybe at 30 years, the rate of return from year 30 to 31 is greater than your salary.
yeah,
A
yeah,
and it's
yeah.
like, you wait, like, your money, by letting it compound, makes more than you can add to it.
Yeah, yeah. And I had these various knobs, like, what if I save 10% of my income and
Yeah.
20% and 30%, 40? I'm like, "Oh boy, what if I save every little penny I possibly
Yeah.
can?" Right? That just got my brain going like, "Hey, this is pretty neat." The other knob that I threw in there is, what if I outperform the market by 1%
Mm.
over this entire period, 2%? And I'm like,
So
"Oh."
this would have been, uh, like 2005, 2006, 2007-ish. It's like, I'm curious what rate of return assumption you used.
Well,
Like, do you remember, any chance you remember that?
not exactly, but
Okay, okay.
maybe it was like 10. I didn't even. It was so rudimentary. I didn't even
Yeah,
think of putting in inflation and other
yeah,
types of
yeah.
things. But I knew the fundamentals there of, if I saved a ton, invested a ton, and if I could outperform, it would be
Yeah.
pretty nice. And the first two were in my control. The third wasn't, but I thought, it didn't occur to me at the time how hard it would be. So I thought, okay, let me just focus on the third, right? Just figure out, beat the market by 1% a year. How
Yeah.
hard could that be? So, with that understanding, I started an investment partnership. I read a ton about investing, and the philosophy that stood out to me the most at that time was Warren Buffett's philosophy.
Okay.
And I also ended up reading A Random Walk Down Wall Street. So those are
Okay.
like two pivotal books in my arsenal that kind of propelled me forward in the investing space. The Random Walk Down Wall Street, basically the notion there is it's very hard to beat the market, and here's why, right?
Yeah.
But it also lays out the power of passive investing and compounding.
Hmm.
So, I ended up putting all of my my retirement assets in my 401k, maxing all that out, and IRA and all that into that passive notion, and that's where it's been for the past couple of decades. But then all of my taxable assets, I formed an investment partnership with a few friends. We pulled our money together. We thought, let's run a long only value strategy like Buffett did before he started Berkshire. Um, and the goal there was to pick great companies at a discount. So I started really getting into the investing side of things. Like, how does
Okay.
investments work, and what works and what doesn't? And what does it mean to pick a stock, and why would you pick this over that, right? And how do
Mhm.
markets operate? So it was a big, I was going to say steep learning curve, but no, that's not right. A shallow learning curve, which is hard to climb, right?
Yeah. It's the J curve idea. Like going from here to here doesn't feel like much.
Yeah. And the crazy part, or I don't know if you can call it serendipitous part, but the interesting part was this was between like 2003 and 2007, and this
Okay.
was a pretty good bull
That's a strong
market
bull
tear,
market.
right,
Yeah.
for the market. And I was like, oh, this is too easy. Like, well, how is this? I didn't say that out loud, but it
Yeah.
was. I'm sure it gave a lot of people that feeling,
Yeah.
especially if you're first getting to stocks and you're in a complete bull period that
Yeah.
things just go up, right? And you can make speculative bets and not, end up dying
Yeah.
instantly. But we still thought we brought some diligence, right? We thought we did what was prudent and made nice decisions, and on paper we had some alpha, right, to show for it as well.
So this is
Over that,
all kind of like side hobby
yeah,
while you're still working full time at the consulting firm.
right, yeah, yeah. And then so year 2, year 3 into the consulting, things are going well, but I feel like I just liked investing so much. I wanted to make a career out of it.
Okay.
Probably what stood in my mind is, hey, that extra 1% of feeding can make so much of a difference. Why can't I just do that? So yeah, I decided to make a career out of it. I went back to business school, went back to Cornell, got my MBA. Interestingly enough, my hedge fund opportunity was at Rain, Caniff, and Goldfarb. So that was actually the firm that was started with Warren Buffett's previous partnership clients. Before he started Berkshire, he used to manage money in a long only partnership.
Okay.
Um, and when he went to Berkshire, he couldn't do that anymore because he had this holding company.
Yeah.
And the plan for
So
Berkshire is to buy companies, not to manage individual money.
this is business school. You're still kind of doing. Were you still doing the investment partnership during business school?
Maybe, but it kind of fluttered a bit because now I was
Okay.
doing it more professionally. For
Okay.
example, with Rain Caniff, they were a long only shop. They had a lot of what we were trying to do with the partnership anyway.
Okay.
And even when I was there, they followed many of the principles of Warren Buffett, so aligned quite well. I think when I was there, they were the second largest holder of Berkshire behind Warren Buffett. So they had a great track record over like 50 years, probably over 60
Okay.
years now of performance. And it gave me an inside view of, okay, this is how the best of the best manage money in a long only strategy, right?
So
Here's what
were
they
you
do.
working there while at business school? Or was this your first job after getting your MBA?
No, this was the internship.
Okay.
Yeah. And so business school, you're required to get internships. It's a big thing for going through that whole process. But so while I was there, though, it was like I was part of the investment team because it was very concentrated. You had less than 24 people managing like 16 billion or something at the
Yeah.
time. And the fund I was on, you had like 4 billion and like 4 people. So like making very important decisions. So I'd be like number 5. And the goal there is to figure out, how do you pick the best stocks, right? And what they did is something known as bottoms up, on the ground research, where
Okay.
you're like an investigative reporter, right? You're
Mhm.
trying to figure out what makes this company tick. You're visiting the stores and you're kicking the
Yeah.
tires and you're doing all that. And
Were you reading financial reports?
yeah, you're reading
And
reports
okay.
nonstop. You're reading anything that you can find about a company. And the interesting part is, because of the scale of this firm, you had pretty good inside exposure. Meaning, if that CEO visited the town, they came to you, right?
Okay.
And you got to speak with them. And a lot of the acumen there, was from like journalism, for example. You had people from like the New York
Mm.
Times, right? And they're good at asking questions to uncover things, right, about
Yeah.
what's going on. Like, you might ask the CEO, that earnings report that you put on, what do you think about those numbers? And then you see, do their lips quiver, right, when they
Mm.
respond, or do they seem confident, or do they look sideways, right, or look away when they're responding? And you try to use all this fuzzy information to come up with some sort of idea of what to
Mhm.
do with the trades. But here's the twist. So at the Cornell Business School, they had an on-campus hedge fund as well. And on that on-campus hedge fund, it had two parts to it. The first part is they had a quantitative model, which said, of these 1,000 stocks, here are like the 50 best, based
Yeah.
upon a mathematical algorithm, like a screen and things like that. So quantitative model, right?
Mhm.
No emotions, just put in tons of data, and it crunches it
Yep.
and says, here's the best. Here's what we think is the best
No
long, the
no
best short.
no fuzziness.
Yeah, right. But then the students would continue to refine that model, but in addition, you'd have other students or the same students say, okay, of that 50, let me do my fuzzy analysis. Let me do my
Mm.
qualitative analysis to see what are the 10 best longs and the 10 best shorts to invest in, to make a position in the market. And then hopefully through that whole analysis, you get something that does well. So, the key light bulb moment for me was, well, why can't we just automate more and more of that fuzzy analysis to take out
Yeah.
the emotion? Meaning, yes, it's qualitative, but you're looking for things, right? You're looking for
Yeah.
specific things that you like. Why can't you systematize that? And it got my engineer brain, really going,
Mhm.
because there was this transition period in investing over that period where things were moving, just like the banks were getting automation. The
Yeah.
investment space was getting more quantitative,
Mhm.
more data driven, more analytical, more model driven, more mathematical, and so on, and more AI and all that stuff. So I think it opened my eyes to a new possibility of investing, where you tie in the fundamental and the qualitative with the quantitative. So I'm now in the investing space, not a planner yet.
Yeah.
I'm inching closer. So when I graduated, we call this like the 2009, 2010 period.
Yeah.
So once again, 2007
You
was glorious for investment professionals. They were
and you managed to graduate twice during like a 30% drop in the market?
right in two of the exact fields that were the
Yeah.
exact worst
Yeah.
timing. Right. So now I have a finance degree in the middle of the
Yeah.
great
Yeah.
financial
I really
crisis.
like you have the engineering degree in 2002, you have the MBA in 2009. That's like, oh man,
Right. Yeah. So not
you're lucky
great.
other things worked out for you so well.
Well, I guess looking back on it, it does feel like a grind, right? Because you don't see the certainty of the future. You see, oh boy, this sucks. Like,
Yeah, yeah, exactly.
and I'm sure a lot of people see that, because, you know, I, it's never that easy. Even the people who graduated a year before, I'm sure they had their own
Yeah.
other struggles, right? And in hindsight, yeah, things eventually work themselves out. But when you're going through it, you're like, oh boy,
I
yikes, right?
remember I moved to the Bay Area to take a new financial planning job in 2008. It's like May 2008, something like that. And like within the first year, it's like, we have to give everyone a pay cut to make we just moved here. So
Yeah.
I remember that.
Yeah, it was like the same thing again, it's just like, oh, you had offer, really? Like
Yeah.
we rescinded and so on. So basically what I ended up doing is I ended up just building my own models. I'm like, okay, I'll just figure out this stuff on my own and see what I can do with it. So I had read a paper recently about, or recently at the time, this is like
Yeah.
2009, 10, about how this person took social media data to make predictions in the market. So that got me thinking. I'm like, okay, maybe I can try this on my own and see what works. So I downloaded the entire Twitter database at the time.
Whoa.
Yeah, and it could fit on one hard drive back then.
I would say like
Crazy enough.
the download, like not every place had the bandwidth to download that whole thing.
Well, you can imagine this is 15 years ago, so Twitter had just gotten started, right? So it wasn't as crazy as it is now. Literally, it would probably fill up a hard drive a second, today.
Yeah.
But before, you could fit everything. And I started crunching it. And immediately, I realized, oh boy, this is too much to crunch. Like, even though it fit on a hard drive, I can't move in any direction without everything crashing.
Yeah.
With my meager resources, a few laptops and servers and whatnot. But what I wanted to do is see, can I use machine learning to throw in this data and figure out if there's some sort of trend in predicting market movements? And I realized, again, the words were too complicated. So what I did is I said, okay, let's delete all the words. So you can imagine what's left. What's left is just the emoticons.
I was like hashtags and emojis or something like that.
Yeah, hashtags weren't as popular back then, but emojis were there, right?
Okay.
So yeah, the emojis were left, and they didn't take up much data. They were just one character, and you could get a lot of information, like happy, sad, right? So I took all the list of like 50 or so emojis, and I made a table that mapped them to emotions, like happy, sad, nervous, etc., right? And then I could count up how many emojis people put out there on a given day, right?
Okay.
And then I could make a time series, and I could normalize that time series, between 0 and 1. And now I have time series data of emotions over time as extracted from emojis.
Okay.
So now the question is there some sort of predictive power with this and how the market performs?
Okay.
So I threw all of that into a neural network at the time. This was something known as a radio basis function support vector machine. But essentially what that tries to do is for any given emotion, it tries to divide the result into good or bad, right?
Okay.
For the market the next day.
Oh, okay, I see. Okay.
Yeah. So now if you have a bunch of emotions, you end up, if you have 2, you can imagine you have a plane of emotions, right?
Yeah.
And if you have 3, you have a cube. And if you have 5 or 10 or 50, you have something known as like a hyperplane, like just n-dimensional plane or object that you want to split into 2, right? Good and bad for the market. So I continued creating those models and research, and I came up with some analysis that suggests that, yeah, there's nervousness that ends up popping up and anxiety that ends up popping up that predicts market declines, right?
Okay.
So then I'm like, okay, now what, right? Nobody's gonna.
How long do you think this project took?
I did it for a couple of months. So this is what I really did. So I was still looking for jobs, but I was doing this to keep busy and something to talk about. Like, hey, what are you doing? I always use this a couple of times, so maybe it's helpful for other people. But if you're unemployed, say you work for yourself.
Yeah.
And all of a sudden you're employed. You don't have a gap in your employment history. So yeah, I was working for myself doing this research project while I was looking for a job.
Yeah.
And what I did is I created the research, I created a presentation, I had a deck, and I had a write up and all of that. And I actually used to send that out with my resumes, right? If I was looking for a job, or if a firm was actually doing what I was trying to do, I'd say, "Hey, have you thought about this?" Right?
Yeah.
And try to get my door in that way. And it's a grind, right? You just do this, send it to dozens and dozens and dozens, and 100 or 200 people, and at some point, a light bulb might go off in somebody's head that, hey, something might be interesting here, right?
Okay.
So I did that, and I got on the radar of this options trading firm out in Southeast Asia. And the CEO and I started talking, and they had a big assessment. They were trying to fill this position for leading the quantitative research team.
Mhm.
And yeah, I remember the assessment even. They sent it over, and my response was like 30 pages. And I actually went through
Yeah.
all of the analysis that they were looking for and questions. And a lot of them were like very fuzzy, but they wanted to know a lot about what makes this person tick, right?
Mhm.
What is driving their ability to exceed and excel and all that. And that's maybe another tidbit there, right? If a company is pretty rigorous in that process, you can imagine they're probably looking for something, orthogonal to the standard, fill out
Yeah.
the questionnaire and answer these questions and do a 30-minute behavioral. But yeah, we found a good synergy amongst each other. So I was hired for that position. I flew out to Southeast Asia to head up the quantitative research team. And the business model is you sell options and hope people buy them. And you hopefully don't sell them too cheaply so you don't go broke. So my goal as the head of the research and quantitative development team is to come up with accurate prices, right?
Okay.
So this is the sole revenue driver for the company. The goal of the team is to sell these products at a fair price. And the notion again is if you sell them too expensively, then nobody's going to buy them. If you sell them too
Yeah.
cheap, you'll get hosed.
Yeah.
Right. So the options space is quite interesting, but quite different.
So does this feel like the movie The Big Short, where one firm is creating these options to sell to others?
Yeah. Well, I can't say.
They were doing like a swap kind of thing. Like they were creating uh, a swap to profit off of
Yeah,
other
because if you're
other.
buying a short, you're buying protection against a crash, and you're hoping the crash happens so you get paid out.
Yeah.
Is how that might work. But I don't recall the specifics of that
Okay.
movie.
But it's more
But
like these options didn't exist. They
mhm,
both had to create them
yeah,
and then had to go out and sell them.
yeah. We were selling these over the counter, so we were selling them through our own engine, meaning we were taking all the risk, right, for anything we
Okay.
sold, and the counterparty was whoever wanted to buy them.
Okay.
And we've talked about this in other conversations, but the general gist is when you're selling options, it's like you're selling insurance policies, right?
Mhm. Yeah.
And your goal as a seller of insurance policies is to not sell a ton of policies in one specific area, right?
Yeah.
You want to spread out your sales so that when
You
one
want
area
your
blows
law
up,
of large numbers with
yeah,
your profit margin.
exactly. And you can imagine if you're buying options, you're buying policies, right?
Mhm.
Now, why would you ever buy a stock option? Well, you're paying a little bit of money, right?
Yeah,
And
you're
like you're
paying that
buying,
premium to protect against asymmetric risk
right?
or
If the market
idiosyncratic risk. Yeah.
if the market crashes, right? You pay a little bit and you get a ton back, something like that.
Yeah.
Okay, but more people were doing something else. They were acting like they were buying lottery tickets. They were spending a little bit
Okay.
of money and hoping for a big payout. And you can imagine we're on the flip side. We're selling these lottery tickets. We
Mm.
know we're going to pay out, but we want to be sure to sell enough tickets to cover the payout.
Yeah.
That's
Yeah.
how it works. So essentially, I became a bookie. So,
Yeah, you're the house.
yes.
You're the casino.
Right,
Like,
right. So, and we called it our book, right? This is our
yeah,
book, and we got to protect it. And if the book crashes, the whole business flops,
it's
right?
like,
We don't want that to happen.
I need to balance out these two sides. So I need to
Yeah,
find the spread. Like, I just want my vig. Like, yeah. uh,
yeah.
Okay.
And so, this wasn't quite investing, is it? So- but it's a career change. It was interesting enough for me to say, okay, there's some excitement here. Crazy enough, a lot of the people on my team, I was in charge of, again, the quantitative derivatives pricing team,
Mhm.
research team, trading team, etc. A lot of people had a mathematical background, but there were a lot of people who liked gambling as well. A
Oh
lot of
yeah.
probability theory. I think one of the people, one of the employees was like a professional poker player, right? And we used to have like weekly poker games and stuff like that, right? So statistics and math is what options is all about, right?
Mhm.
Probabilities, in fact, is what underlies the Black and Scholes equation, the main option pricing formula. But the way that kind of played out is it, it gave me a pretty good open understanding of there's a world of possibilities out there. And the
Mm.
way this kind of happened is when I first got there, the P&L of the business was quite rocky. Sometimes we didn't even know if we would make, enough to cover payroll, things like that.
Oh
We're like, oh boy, we just lost a ton on this side, right?
yeah.
And it's a little nerve wracking. I remember the CEO sat me down very early, like in the first few days, and he said, you know, I guarantee you're gonna come in one day and you're gonna be down $1 million. It's gonna happen. And it's gonna be on your shoulders, and you're gonna have to deal with it. And you're gonna have to pull, the emotion aside, and you're gonna have to come up with what makes the most sense based upon what you're seeing. Yeah, and make a decision. And he's like, I don't know if it's going to happen today, tomorrow, or next week, but it's going to happen.
Mhm.
And now I'm like reliving some of this in real time because I actually
Yeah.
don't mention this quite often, or haven't in like a decade. But I remember that first summer where we had a streak where I came in one day and we were down like a couple $100,000. And I remember our firm overhead for the month was a couple $100,000. We're like,
Yeah.
oh, there goes there goes everything we need to make payroll. Right? Okay, one day's not bad, and we're like, okay, let's figure out what's going on here, right? And see, do we make a mistake? Do we get an off by one error? Is something wrong with our feeds? Are we selling things in the wrong place, right? And it's just one of those stressful events, and then the next day, boom, you're down another 300,000. And we definitely broke that $1 million mark over that summer, and it just showed me a couple things. It showed me that we were doing a lot of trades in places that we really didn't know too well,
Oh.
right? We were trying to be too broad in what we were trying to do and the types of products we were offering. There's many different types of options, and you can get very creative with building them, but they get very complicated quickly. So if you don't have your math buttoned down, then obviously you can get your knees chopped off. So the first few 6-9 months or so, we were actually cutting a lot more than creating anything. So it
Mm.
gave me this understanding, very nuanced understanding of risk and the power of being
That's interesting.
purposeful in
So
your management.
so we talked like that. That insurance is a great analogy because like you wanted to like diversify your risk so you don't have too big of bets in two specific areas,
Yeah.
but that spreading out the risk kind of created like a lack of expertise almost
Hmm.
on some of those fringes.
Yeah, you're exactly right. There were some areas where we just didn't know as much as we should have in what we were
Yeah.
doing, right? And some of the models weren't as great as they could be, but here we were pretending like they were, right?
Yeah.
So it meant we had to cut a lot to
Mm.
grow, right? We had to get rid of a lot of things and turn things off and reduce and slim things down. which is again not what you want to do, right? You want to grow and diversify
Grow
and
and expand, and yeah.
yeah. But it was certainly well worth it because it's one of those things where a few slips can mean the whole thing, right? If you're
Yeah.
selling 100,000 instruments, but in one key area, you have a place where somebody can take an outsized advantage. Well, that's enough to take down everything when,
Yeah.
somebody can place very large positions within the business or on our books. So yeah,
Do you remember what led to leaving there and moving back to the US?
yes, certainly. So what ended up happening is, okay, so the first 6-9 months we did that. We ended up having to cut down and cut back and rethink and refactor a lot of our
Mhm.
thinking, right? But then after the next 6 months, we actually started building again, properly and, taking our time to make sure things are right and putting them out there. And that actually led us to making our prices even more competitive in the market, which
Mm.
led to growth in the business. So, after that first year, we did about 150 million in option sales, which for the business now, it doesn't sound like much, but back then it was a lot. It was like a firm
Yeah.
record. And then the next year, it was just pedal to the metal. Let's just double down and do everything again, but just for one more year. And we hit about 250 million in sales. And then the third year, we hit 450 million. So we had grown the business by
Mhm.
multiples, right, over that time. I'd grown my team from like 2 to 8 people, something like that. Things were going quite well, but here's the shift. I had since gotten married and I wanted to settle down. So that's what brought me back to the United States.
Okay.
I ended up doing another search and I found a hedge fund that was just getting
Mhm.
off the ground here in Florida, where I am now, West Palm Beach. And the notion there is they were looking for somebody to head up and with these initiatives to build strategies to outsmart the market. So here's the transition point. When you're an option seller, you are effectively on the sell side, you're selling, right?
Mhm.
And you're trying to create markets and sell products, in this case, options.
Yeah.
When you're on a hedge fund, you're on the buy side, right? And the buy side is trying to buy things to make more money, right?
Okay.
And in the investment space, if you're starting out, you have this understanding pretty early on. Buy side is kind of where you want to be. That's where all the
Mm.
flashiness is, right?
Like
That,
you're gathering assets for clients and then investing those assets.
yeah, yeah. And on the buy side is where you hear those big news stories of people becoming billionaires, right?
Okay.
By
Yeah,
starting
yeah.
hedge funds and stuff like that. It's where all the glitz and glamour is. And like the sell side is like a slow and steady like insurance business, right? It doesn't sound too
Mhm.
exciting,
Yeah.
but it's a phenomenal business, right? Because you're
Yeah.
like the right, but it's not flashy and glitzy. So yeah, I wanted to give my bat at the buy side,
Okay.
and that's how I transitioned back to this hedge fund that was just getting off the ground in Florida. What I brought with me is this understanding of managing risk, right? Which is very important on the hedge fund side, and a very strong understanding of how the option market works.
Mhm.
Because, when I first joined that firm, we were using pretty rudimentary models like Black and Scholes, which is
Mhm.
40, 50-year-old tech. But by the time we left, we were using cutting edge, state of the art institutional type models that they use at
Okay.
big banks to price these things. And I had that knowledge with me. So I thought maybe we can apply the understanding of the options market to make money on the buy side, was the theory that
Okay.
went through my head at the time. So I teamed up with this hedge fund, started on the ground floor, came in, with partner shares and started with like 2 people in my team. The goal was to make strategies that can
Mhm.
outsmart the market. So I started research in the volatility space. Uh, the interesting part about being in Southeast Asia is it got me to think more globally, right?
Okay.
Because in the US, you think about all the US markets and you hear S&P and
Yeah.
Dow and all of that. But when I was international, I learned about all the global markets because by the
Yeah.
time I left, we had traded everywhere. So any major exchange on the planet. And we also traded beyond just stocks and indices. We did currencies and commodities. So I had a good understanding of the nuances of all these other markets as well. So at the hedge fund, we're looking for strategies. Okay, how do we outsmart the market? How do we figure out a way to use this understanding to come up with a strategy? The strategy that we were building was purely systematized, meaning no emotion. It comes up with data that goes in, and it comes up with trades on what to buy and then sell. And then it does this over time so that it's systematized and non-emotional. So these are known as quantitative investment strategies in the alternative space. Alternative is like
non-stocks.
It's like
commodities,
non-stock
currencies.
Not traditional. So maybe like it's code word for hedge fund a little bit. So we did this, did quite well in terms of coming up with an idea and then putting it to work. I was there for like 3 years, and we grew the business from like nothing to like over 100 million. My team grew from like 2 people to like 7 or 8 people. And we came up with a strategy that took into account anomalies in the risk market, volatility market, the VIX specifically. So basically, all options are a prediction of how volatile something is going to be. That's it, if you break it down. And Aaron, you and I have talked about this, but the VIX is basically a measure of this volatility through options, but kind of inverse calculated, and it gives you a barometer on the nervousness of the market. Right, when VIX gets high, market is very nervous. When VIX gets low, it's very calm. And it turns out you can buy the VIX as a product because anything can be productized in the finance space. I think you could bet on the election this time, with all the crazy, or like literally like what percent did Trump win in each given state.
They have been doing betting markets for different political races where like if you pay 55 cents for a bet, like that's a 55% chance it's going to happen. If it pays off, if you win, you get $1. If it doesn't, you get 0.
Right.
So that probability fraction. So like if you pay 90 cents for a 90% probability, you can only make 10 cents, I think.
Right.
But you could lose 90. But if you pay the 10 cents and it does pay off, you're like getting a 10% return. Like it actually tracks like market measuring of probability pretty well. Like it's a kind of a crowdsourcing idea, but it's like people are putting money on prediction markets, and I participated in a Stanford program. They're trying to test how well people could do predictions by just crowdsourcing. And it's one of those things like nothing can predict the future. But this is not bad.
Yeah. Frankly, that's exactly how the options market works, right? Because you have people coming up with the chances of the option landing in the money, right?
Yeah.
And then you inverse Black-Scholes that, and you get a volatility number.
Yeah.
And you can use that to make other options, like what are the chances it's 10% out of the money and stuff like that, right? And what if the S&P is above this cutoff and all of the things like that. And those same formulas you could apply in the sports betting space, I'm sure.
Yeah. So you're at a hedge fund here in the U.S. We've talked about like the fire story a little bit in the past. I don't know what's wrong with that. Like, I'm curious, like you've been a manager most of your career and you've enjoyed that, but at no point in your founding your current firm have you ever considered being like hiring an employee from what I understand.
Yeah.
So like I'm curious like how this background has influenced your business today.
That's interesting. I have. It's so interesting. But part of the reason why I felt good in the management spot is because I think I had this underlying goal. How do I make things super efficient?
Okay.
meaning what can I do to make this situation easier for me?
Okay.
Essentially, right? And with management, my goal with many of these positions was to make myself obsolete.
Mm,
Meaning, how do I create a process that can be self-governing and self-perpetuating and self-growing to the point where things get so efficient, I don't have to do anything.
okay.
And that was kind of my goal with growing and building these teams, empowering my employees to do what they need to do, and then just leave the whatever little is left for me to figure out how to make that efficient as well, and then grow and expand and grow and expand.
Have you ever considered doing that for your current business?
No, not gonna happen.
Eh, so kind of like why not? Like, what's the difference?
Yeah. So, well, okay. So let me tie in the transition just a
Okay.
little bit. So, what basically happened a few years into the hedge fund is around 2017. I was like 37 years old. My daughter was born that year. And I just sat down with my wife and I said, we actually have enough in our own personal portfolio that's
Hmm.
generating enough passive income so we don't need the paycheck anymore. And I mentioned this maybe a few episodes ago. I started writing a book with my father. I
Yep.
quit the hedge fund. I took off, and I had no real plans to do anything, no real plans to grow any sort of business. In fact, I think that's where my ambitions to create big, large things kind of fell away. I just felt
Okay.
it wasn't necessary anymore. I had done what I needed to do in that space, and it did what I wanted to do. I now had this passive business,
Hmm.
my nest egg, that was doing quite well on its own with almost no effort.
Okay. So
Yeah,
that's where the efficiency is.
I think
Is
so.
like
I'm like,
you've built up the like you don't have to do any of the work and you still have have the income kind of thing.
yeah, frankly, what kind of happened, I switched jobs 3 times at that point, the consulting, the options, the hedge fund. I
Right.
think in each of those times, I got to the point where I felt like my role didn't quite matter anymore. Everybody in my team was doing what they're supposed to
Yeah.
do. What do I do now? I'm reporting to the CEO. Like, okay. So, the challenge was different at that point, and I felt like, well, I'm not the boss, so I can't do what I really want.
Yeah.
But I was also burnt out, after doing that for so long. So yeah,
So
so I transitioned.
I think I might want to hold off here because
Okay,
I have a lot of questions about investing forever, your firm,
yeah,
and I I think this is going to be a longer part of our conversation.
okay,
So like before we get to investing forever,
yep.
is there anything else you want to kind of wrap up with, like related to your blog or the writing or like kind of, and I also want to talk about like the self-awareness that you have enough is incredibly rare. And I want to explore that a little bit as well.
Yeah,
But that's gonna take longer.
it is, because I think you just opened another can of worms. That whole, why don't I have any other employees? And I also have something else to mention about that, but it's probably for the next one. So
Yeah.
here's a teaser.
Okay. Okay. So anything else you want to kind of wrap up with about your pre-fire career or anything other thing there that you still kind of take with you today?
Yeah, well, I think when I made that transition to financial independence, what was really going on the back end is I still had that principles that I learned when I made that first spreadsheet. When I got that first job
Mm,
of, hey, what if I really do save a lot, and what if I
mm,
really do put it to work? And I had been doing that mostly in a passive fashion
yeah,
because I had actually wound down that partnership by the time I finished business school. And from
yeah.
that point on, it was pure passive. So I think the diligence of all of that passive investing and that diligent savings and keeping life creep under control
Hmm.
was actually what made that transition possible.
Okay. Okay. I I'm excited for our next episode now. So like I have questions lined up for you. Because yeah, we'll save it for next time because this is going to be either hard for you to answer or really easy for you to answer.
Well, I look forward to some hardballs, so I'm excited too then.
Okay. I'll see you next time, Trishul.
Thanks, Aaron. I enjoyed the conversation. And thanks, everybody, for listening and watching. If you like these episodes, do subscribe and share. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.